Welcome back to the Deep Dive. Today, we're cracking open the books on Honda Motor Company. We've got their Q2 fiscal year 2026 results, which covers the 6 months ending September 30th, 2025. And, well, the headline numbers, they look pretty rough.
Yeah, rough is putting it mildly. We're talking about operating profit absolutely plummeting, down 41.0% compared to last year.
41%.
Yeah, settling at JPY $438.1 billion for that 6-month period. That's, billions and billions of yen just gone from the profit line compared to the previous year.
A drop like that, it's not just a blip, is it? It feels like a major strategic tremor. And it clearly spooked management. They immediately cut their full-year forecast by JPY 150 billion.
Exactly, a big revision downwards. So that's our mission today, right? We've got the earnings call transcripts, the financial documents, and we need to unpack this. Where did all that profit vanish? Is this like a one-off painful hit they had to take, or are we seeing signs of some deeper, maybe structural issues at Honda?
That's the core question we need to tackle. Because digging into the sources, it almost looks like Honda is running as two completely different companies under one roof right now.
It really does. You've got one part that's just, well, a cash machine performing incredibly well, and then there's the other part struggling, losing money, kind of caught in this difficult transition with technology and these geopolitical costs.
Okay, let's break that down then, this tale of two businesses. Because the difference is, frankly, pretty startling. Where's the good news? Which bit is actually making the money?
That would be the motorcycle operations. Honestly, this segment is just on fire. For the first half of the year, they didn't just do well. They hit record highs, record unit sales, record operating profit, JPY 368.2 billion.
Okay, impressive profit number.
But here's the kicker. Their operating margin was 19.2%. 19.2%.
Wow, almost 20% margin in mass manufacturing. That's almost unheard of for a big vehicle maker. It speaks volumes about efficiency, pricing power, everything. Where's that growth coming from?
It's pretty global, actually, but really strong in certain emerging markets. Brazil and the Philippines were called out specifically as driving solid sales. They did see a bit of a dip in unit sales in Vietnam, interestingly.
Yeah.
But overall, the volume and the profitability elsewhere are so strong that, yeah, you could definitely say the motorcycle division is kind of acting like Honda's internal bank right now. Or maybe an ATM just spitting out cash.
Right, the cash cow funding everything else. So that's the bright spot. Now, let's flip the coin and look at the automobile business, because this is where that huge 41% consolidated profit drop comes from, isn't it?
It absolutely is. The automobile operations segment, well, it didn't just have lower profit, it posted an operating loss, a significant one. JPY 73.0 billion for the first half.
A loss of 73 billion yen. And how does that compare to last year?
That's the shocking part. It's a swing of JPY 331.0 billion downwards compared to the same period last year. A massive negative change.
Okay, a 331 billion yen negative swing. That can't just be, sales slowing down a bit. This must be where that term management used comes in the noise.
Exactly. They pointed to these huge, supposedly non-recurring items, this noise totaling around JPY 450 billion, as the main reason for the consolidated profit collapse and the auto loss.
450 billion yen in noise. Did they explain what that actually means?
They did provide an adjusted view. They said, look, if you take out this noise, the sort of underlying operating profit would have been JPY 826.2 billion. And that translates to an underlying operating margin of about 7.8%.
Right, okay. But hang on. Management wants us to focus on that 7.8% and think, see, core business is okay. But is 7.8% really that great for an adjusted half-year margin? Especially when motorcycles are pulling nearly 20%. It sounds a bit like they're trying to downplay the underlying weakness too, doesn't it?
That's a really fair point. You have to question that framing. I mean, 7.8% isn't a disaster. It suggests the core isn't, completely falling apart. But it's certainly not market leading, especially if it relies heavily on their older profitable models.
So, still vulnerable.
Definitely vulnerable strategically. But okay, let's perk the underlying debate for a second. We still need to understand the two big shocks that make up that JPY 450 billion noise figure. What was the biggest one? I'm guessing EVs.
You guessed right. The single largest chunk was a JPY 223.7 billion one-time cost related to electric vehicles.
223.7 billion, was that investment or?
No, this wasn't building factories. This was basically a cleanup cost, a provision. It covered expected losses on EVs they're already selling, mostly in the US it seems, and significantly huge write-offs of development assets.
Write-offs. So money spent on R&D for cars that won't happen.
Precisely. It's basically them admitting some strategic missteps. They had to cancel the development of certain EV models altogether,
Yeah.
and they're stopping or seriously scaling back manufacturing for some jointly developed EVs under an alliance agreement.
Wow. So they effectively spent over 220 billion yen just to erase past mistakes on their EV roadmap.
Yeah.
That's an incredibly expensive reset button. A very costly reset, yes. It shows the initial strategy just wasn't hitting the mark, either with customers or on the cost side.
Okay, so that's the big self-inflicted EV pain.
Yeah.
What was the second major shock contributing to this JPY 450 billion noise? The one they said isn't going away.
That would be tariffs. Geopolitical friction hitting the bottom line. Tariff impacts cost Honda JPY 164.3 billion in Q2 alone.
164 billion
Yeah.
in one quarter.
Yeah. And the really crucial part, maybe the most concerning, was the language management used. They described this tariff hit as the new normal.
If it's the new normal, then it's not really noise anymore, is it? It's a structural cost. It's baked in. Why now? And why can't they just build where they sell to avoid it?
Well, the sources suggest they're finding it hard to shift their supply chains and production footprints fast enough. This cost seems to be hitting components moving around the globe, especially stuff related to North America. The sheer scale of it, 164 billion yen in 3 months, is just eroding profitability, even where their sales volumes might look okay.
Okay, so we've got the massive EV cleanup cost and this persistent tariff headache. That explains the past 6 months. But then they also cut the future forecast, the full year outlook, by another JPY 150 billion. What new pressure caused that?
Right. That JPY 150 billion cut was all forward-looking, and management pinned it on one specific thing coming back to bite them,
Which was?
the semiconductor shortage. It's back, but this time in a very specific, targeted way. That entire 150 billion downward revision, they attributed it solely to the expected impact of this particular chip shortage.
Wait a minute. 150 billion yen hit because of one supplier. That sounds less like a general market shortage and more like a massive supply chain vulnerability on Honda's part, doesn't it? Blaming the shortage feels like masking the risk they took by single sourcing.
That's a very sharp interpretation, and I think it's spot on. The documents explicitly state the bottleneck is with chips from a single supplier. They even mention Nexperia, and this specific failure forced major production cuts, mostly hitting North America, which is, usually their big profit center.
How bad was the hit to North American production from this one supplier issue?
It was significant. They had to slash 110,000 units just from the North American forecast because of this.
Ouch.
Yeah, and that's a big reason why their total global auto sales forecast for the year dropped from 3.62 million down to 3.34 million units. A huge volume cut thanks to one component problem. They hope to get production back online around the week of November 21st, but the damage is done for the forecast.
So they can't build enough cars because of this chip issue. And at the same time, it sounds like they're struggling to get good prices for the cars they can build. Management mentioned expected price increases didn't quite land as planned.
Right, they got caught in a pricing vice, essentially. The plan was clearly to raise prices, partly to offset those massive tariff costs we talked about.
Makes sense.
But then other automakers, their competitors, reacted by ramping up incentives and discounts. So Honda couldn't really make their price hikes stick in the market in real terms. It completely blunted their ability to pass on that new normal tariff cost to the buyer.
Okay, so balance sheet shocks, production cuts, pricing pressure. Let's shift focus geographically now. What about key overseas markets? The outline mentions Asia, specifically China and the ASEAN region. That's usually a big volume area for them. What's going wrong there?
Yeah, things aren't looking great there either. They had to cut their full-year Asia forecast by 165,000 units. That signals some pretty fundamental problems. In China, it seems like they're facing issues on two fronts.
Okay.
First, their traditional cars, the gasoline, ICE, and hybrid HEV models, are just getting hammered on price. Competitors are throwing huge discounts out there, and Honda's struggling to compete on that value-for-money perception.
Losing on the legacy tech. What about their newer tech, their EVs in China? That market's moving incredibly fast.
That's the second problem. Their battery electric vehicles, the BEVs, are seen as, well, pricey for what you get. The transcripts specifically mention they lack advanced features that Chinese competitors offer as standard now.
Like what kind of features?
The big one mentioned was navigation on autopilot, or NOA.
Can you just quickly explain NOA for listeners?
Sure. NOA isn't just adaptive cruise control, it's more like a level 2 plus driver assistance system. It handles highway driving, including things like automatic lane changes, navigating complex interchanges, following the route and the navigation system, all hands-on for the driver. It's becoming almost an expected feature on new EVs from local Chinese brands.
I see.
And Honda's EVs apparently don't have it, or not at a competitive level. So when you combine a high price tag with missing features like that, their BEVs just look, well, outdated compared to the local competition.
That's a really tough spot to be in, losing on price with the old stuff and losing on features with the new stuff. What was the immediate impact of this, particularly in China?
Well, the most direct consequence was a strategic backtrack. They had to postpone the launch of their anticipated EA Series GT EV model. It's pushed beyond this fiscal year.
A delay.
Yeah, and management explicitly said they need a complete review of their product lineup and planning strategy for China. This isn't just a minor scheduling slip. It feels directly connected to that huge JPY 223 billion write-off we discussed earlier. It suggests a really significant and costly misread of the Chinese EV market.
Okay, so facing all these massive challenges, the costs, the production snags, the competitive issues in key markets, what's Honda's immediate game plan? They've paused a key future product. What are they doing right now?
They seem to be shifting into a very defensive mode, focusing on damage control and shoring up the core. For the existing tech, the ICE and HEVs, they use the phrase fundamental changes in actions.
Which means?
It means cutting costs, hard, rationalizing fixed expenses, optimizing manpower, which usually means headcount adjustments, and really focusing investment only on making the profitable ICE and HEV models even more profitable and competitive.
So doubling down on the legacy tech to generate cash.
Pretty much. They need those profits to fund everything else. And for the BEV sector, the immediate goal isn't growth or market share anymore. It's simply loss mitigation. Get to break even. Minimize the red ink.
How bad could the BEV losses be otherwise?
They actually put a number on the potential gross loss without these actions and provisions, a staggering JPY 650 billion. That includes the JPY 250 billion total provision they set aside for that EV cleanup. So the focus now is just stopping the bleeding on EVs.
Right. So putting this all together, the massive cleanup costs, the ongoing tariff burden, that specific supply chain failure, the strategic retreat in China.
Yeah.
The big picture, financially, seems pretty clear, doesn't it? Honda is basically leaning very heavily on its strong balance sheet and that incredibly profitable motorcycle division. They're acting as the safety net, funding this super expensive, frankly, quite painful transition in the car business.
That's exactly right. And you see that reflected in their decision to keep the dividend stable, 70 yen per share, unchanged. It's a signal to the market saying, we can handle this. We have the resources.
Yeah.
Their operating cash flow, even after R&D spending, is still quite strong. JPY 1,281.3 billion. They're definitely using their reserves and using the profits from motorcycles to buy time. Time to fix the car division.
Yeah, it's not about whether they'll survive. They clearly have the financial muscle. It's about whether they can get the strategy right for automobiles. They just admitted key parts of their EV plan failed, costing them hundreds of billions.
That really is the nub of it. They've taken the financial hit with those big EV charges. They've delayed key launches. But the market realities, the competition, the cost pressures, they haven't gone away. So here's the thought to leave you with. Honda's immediate goal for autos is just minimizing losses. Okay, but looking ahead, what concrete structural actions beyond just cutting overheads will they need to take next year to convince you, the listener, that their big EV ambitions can actually lead the car division back to profitability? Maybe not motorcycle-level profits, but solid, sustainable profits. That's what you need to watch. Can they fix the cost per vehicle on EVs, and can they launch redesigned EVs that actually compete on features and value this time?